Hey everybody, Dr. Phil here. So this is going to be a video on financial statements, taxes, and cash flow. So let's go ahead and jump right into it. So the first financial statement I want to talk about is called the balance sheet. So this is a financial statement showing a firm's accounting value on a particular date. And notice it says accounting value. Doesn't mean like the market value, just showing the accounting value. So this organizes and summaries what a firm owns, which we call assets, what a firm owes, which we call liabilities, and the difference between the two, which is basically equity. So we could think of equity as assets minus liabilities equals stockholders' equity. Now, assets are classified as either current or fixed. A fixed asset is one that's got a relatively long life. It may be tangible. So, for example, a truck or computer, or it could be intangible, so like a trademark or a patent, as an example. A current asset has a life of less than 1 year. So, for example, things like inventory, cash, supplies, accounts receivable, those are all typically going to be current assets. Liabilities are the first thing listed on the right side of the balance sheet and are classified as either current or long term. Um, Current liabilities have a life of less than 1 year, while long term liabilities are debts that are not due in the coming year. And I kind of alluded to this a second ago in the lecture, but the accounting equation is assets equals liabilities plus stockholders' equity. Another way you could say that is what we have equals what we owe plus what's left over. All right, shareholders' equity. So this is common equity or owner's equity. So this is the difference between the total value of the assets, current and fixed, and the total value of the liabilities, current and long term. So again, look at the equation at the bottom. Assets equals liabilities plus shareholders' equity. Now the balance sheet is called that because it balances, right, the value, or the value of the things on the left side, and it balances them against the right hand side. So assets typically on the left, I should say, and then liabilities and equity on the right hand side. So the construction of the balance sheet is typically as follows. So the total value of the assets, we have current assets is typically first, that's usually ordered by liquidity. And then below that, fixed assets. So number one, tangible fixed assets. And then number two, intangible fixed assets. Um, and then if you look on the right hand side, we have the total value of liabilities and shareholders' equity. So we have current liabilities. And then you notice we've got this term working capital, net working capital. So just think of that as, what would you have left over in current assets if you had to just immediately pay off your current liabilities? And we have long-term debt on the right-hand side and also shareholders' equity. So net working capital. So I just kind of alluded to this. We'll just kind of run through this briefly. So net working capital is the difference between a firm's current assets and its current liabilities. It's positive when cash that will become available over the next 12 months, that is current assets, exceeds cash that must be paid over the same period, which of course is current liabilities. And it's usually positive in a healthy firm. This also is what we call liquidity, as you see below. Think of liquidity as a firm's liquidity is, basically nearness to cash. Can they pay their bills in the short term? Also important with respect to debt versus equity, and also market value versus book value. So liquidity refers to the speed and ease with which an asset can be converted to cash. The two dimensions are ease of conversion versus the loss of value. So a highly liquid asset is one that can be quickly sold without significant loss of value, while an illiquid asset, strange word, I know, is one that cannot be quickly converted to cash without a substantial price reduction. Assets are typically listed on the balance sheet in order of decreasing liquidity, with current assets being relatively liquid and fixed assets being relatively illiquid. So the more liquid a business, the less likely it is to experience financial distress. At least we could say in the short term. If a firm borrows money, it usually gives first claim to the firm's cash flow to creditors, with equity holders entitled to only the residual value. Use of debt in firms' capital structure is called financial leverage, in the sense that they're leveraging debt with a cost of capital associated to make hopefully more money than the cost of capital. So if we look at U.S. corporation 2020 and 2021 balance sheets, this is kind of the setup, right? So now bear in mind these numbers are in millions. So we've got our current assets on the left, at the top, and then we've got our fixed assets below that. Notice that the total assets 2756, 3173, again numbers in millions, is equal to the total liabilities and owner's equity on the right hand side. So let's talk about market value versus book value. So values on the balance sheet for the firm's assets, but earlier they referred to this as accounting value. This is also called book value, and they're generally not what the assets are actually going to be worth. Now, based under what we call GAAP, which is the framework we use here in the US, or that stands for Generally Accepted Accounting Principles, audited financial statements in the US mostly show assets at historical cost. That is, assets are carried on the book of what the firm paid for them, no matter how long ago they were purchased or how much they're worth today. There's no necessary connection between total assets shown on the balance sheet and the value of the firm. And a lot of people don't realize that. They look at a balance sheet and they think, oh, this is what these assets are worth. That's not typically the case. For financial managers, accounting value of stock is not especially important. It is the market value that matters. The market value of an asset depends on things like its riskiness and cash flows, neither of which have anything to do with accounting. So let's take a look at an example of market value versus book value. This will help you understand it. The Klingon Corporation has net fixed assets with a book value of 700 and an appraised market value of about 1,000. Net working capital is $400 on the books, but approximately 600 would be realized if all the current accounts were liquidated. Klingon has $500 in long-term debt, both book value and market value. So what is the book value of the equity? What is the market value? So to answer this, we can construct two simplified balance sheets, one in accounting or book value terms, and one in economic or market value terms. So that's what you see below, right? So if we look at assets, the book value of the assets is 1,100, right? 400 plus 700. And then the market value is 1,600, 600 plus 1,000. And then if we look on the right-hand side of the balance sheet, right, liabilities and shareholders' equity, we have 1,100, 500 plus the 600, but again, versus 1,600 for the market. So in this example, shareholders' equity is actually worth almost twice as much as what is shown in the books. The distinction between book and market values is important precisely because book values can be so different from true economic value. All right, so that's a little bit about the balance. Let's a little bit about the balance sheet. Let's talk about the income statements. So this is all sometimes also called the profit and loss or P&L. So the income statement is a financial statement summarizing a firm's performance over a period of time, usually a quarter or a year. Could also be a month. So the income statement equation is simply revenues minus expenses equals income. So the first thing reported on the income statement would typically be revenue, which is just, as the economists would say, P times Q, price times quantity, and of course expenses from the firm's principal operations. So when we say principal operations, kind of like what are they in business? What are they in business to do? Subsequent parts include, among other things, financing expenses such as interest paid. Taxes are going to be reported separately. And the last item is net income, that is bottom line. Given you probably heard that expression, like what does this do to our bottom line? You hear it in movies, etc. And the idea there is it's actually called the bottom line because it's literally the bottom line of the income statement. Here's an example of an income statement for, just sort of a random corporation. So you can see we've got net sales, we've got cost of goods sold, we've got depreciation, we've got earnings before interest and taxes, typically abbreviated EBIT. We've got interest paid, we've got taxable income, we've got the taxes, they pay 21% income tax, we've got net income, and then we've got dividends and retained earnings. So a financial manager should keep three things in mind when looking at an income statement. So the first is GAAP. As a result of the way revenues and expenses are realized, income statement figures may not be representative of actual cash inflows and outflows that occurred during a particular period. Number two is cash versus non-cash items. Non-cash items are expenses charged against revenues that do not directly affect cash flow, and depreciation is a good example of such. And they're crucial to separate cash flows from non-cash accounting entries. And number three is time and costs. Product costs include things such as raw materials, direct labor expense, and manufacturing overhead. And we compare those versus period costs, which are incurred during a particular time period, and might be reported as selling, general, and admin expenses. That's how they're typically reported. Now, what about cash flow? Because ultimately, cash flow is the most important thing. So cash flow means the difference between the number of dollars that came in and the number of dollars that went out. No standard financial statement presents this information in the way that we wish. There is a statement of cash flows. This is a standard financial accounting statement, but it's concerned with a somewhat different issue. The cash flow identity says the cash flow from the firm's assets is equal to the cash flow paid to suppliers of capital to the firm. Cash flow from the assets equals cash flow to creditors plus cash flow to stockholders. Cash flow identity reflects the fact that a firm generates cash through its various activities, and that cash is either used to pay creditors or paid out to the owners of the firm. And then cash flow from assets. So cash flow from assets is the total of cash flow to creditors and cash flow to stockholders, consisting of the following three components. Number one, operating cash flow, which refers to cash generated from a firm's normal business activities. So think about revenue generation. Number two is capital spending, which refers to the net spending on fixed assets, which is purchases of fixed assets less sales of fixed assets. So think about the difference between the two. And then third, change in net working capital, which is measured as the net change in current assets relative to current liabilities for the period being examined and represents the amount spent on net working capital. Cash flow from assets is sometimes called free cash flow, referring to the cash the firm is quote unquote free to distribute to creditors and stockholders because it's not needed for working capital or fixed asset investments. Now, operating cash flow is calculated as revenues minus costs and tells us whether a firm's cash inflows from its business operations are sufficient to cover its everyday cash outflows. They do not include depreciation or interest in the calculation, but they will include taxes. Negative operating cash flow, of course, is a sign of trouble, and different calculation is used for operating cash flow in accounting. Net capital spending, that is CapEx, which stands for capital expenditures, it's a common abbreviation in business, is money spent on fixed assets, less money received from the sale of fixed assets. And it could be negative if the firm sells more assets than it purchases. The change in net working capital is found by taking the difference between the beginning and ending net working capital, abbreviated NWC figures. And it's often referred to as the addition to net working capital, because we would hope that number would be going up. And here we see cash flow to creditors and stockholders. So cash flow to creditors is calculated as a firm's interest payments to creditors less net new borrowing. And it's sometimes called cash flow to bondholders. So as an example, we see below interest paid was 70 minus 46 for net new borrowing, which gives us a cash flow to creditors of 24. Now, cash flow to stockholders is calculated as dividends paid out by a firm less net new equity raised. In this example, 123 dividends paid minus 40 for net new equity raised gives us cash flow to stockholders of 83. All right, thanks for watching the video, and I will see you all in a future video. Take care.